Today we're going to talk about some convexity and conviction in a zero DTE world. Tom, I feel like if you're going to engage with convexity, you've got to have some conviction. Would you agree with that?
I'm not sure what you mean by convexity and conviction here. I would love to know more.
Well, let's do it.
I'm sorry, wait a minute.
Man, that's a lot of ice. That's a lot of
ice in front of the mic, everybody. He had a 90-second break. It wasn't enough time for him to pour his ice then. He's going to do it for you now. A little
Don't
ASMR.
blame me for the ice. I've been over-iced. I've been over-served ice this morning. Beth has been
I got to tell you something.
You're welcome.
Sadnov is fresh off a 0-day trade that he made on Friday, and he was profitable in Atlanta on it.
Excuse me.
That don't usually happen.
Two zero DT trades in front of the whole audience.
Okay, so this is great. So I'm curious, the zero DTEs, because this is going to be a perfect segue into today. Were they long trades or short trades? I'm sorry. Were they long option trades or short option trades?
No, they were both
short premium.
They were both. One was a short iron condor. One was a short strangle.
So both short premium. Okay. So look at you, man. Kind of cheating death a little bit. I like it. I like it a lot. Not so much with the iron condor, but
and one was to be fair, one was pre-market, right, Tony? The ES was pre-market, and the SPX was 5 minutes after the market opened.
Well, nothing could be pre-market if the options are open. Then the market is open. It was pre the stock market opening at 9:30 Eastern time. Yes.
Yeah. Okay. All right. Well, interesting. I think you kind of dodged the Reaper there with some short premium. I like it. All right. So Beth, hit us on the intro slide, and let's do it. So few financial products have exploded onto the scene quite like zero DTE options have over the last couple of years, and these strategies offer us unique risk return profiles that differ from our typical in of 45 out of 21 type of trades. But with that gimme in the form of flexibility comes a pretty formidable gotcha in the form of convexity, Tom. So I was thinking about, obviously zero DTE options have exploded onto the scene. Like it was hard for me to think about other financial products or other moments in the market's history that maybe had this much, chutzpah. I think, and I'd be curious to get y'all's take on this, decimalization. So this was in the late 90s or early 2000s, I think, right? When they moved from teenies, right? It was teenies to decimalization. Is that correct?
Well,
that was a huge thing. Was that not a huge thing? That was a huge thing.
We moved from fractions to decimalization. Yes, it was a huge thing.
So it was teenies, fractions, decimalization?
Well, there were a lot. When you say there were, we had sixteenths, eighths, quarters. There were different fractions for different prices.
Yes, of course. Oh, okay.
You have to remember the bonds and notes today still use fractions.
Of course.
Yeah.
Of course. Yes. So whenever the final jump was made, though, to decimalization, which obviously is where we still are today, was that not a big moment in the history of the market?
Well, it was a huge moment because it allowed the marketplace to. I think it was one of the springboards that allowed the marketplace to kind of really grow because fractions, believe it or not, fractions scare people. They're just not. They just people don't like to trade in fractions.
Well, it's also a lot. It's not even about fear. It's about the expense of the trade, though, too. I mean, when the market can only be a fraction wide, that's significantly wider than a 1 penny market in SPY or a 1 penny market in Apple.
Of course. I mean, we went from the smallest tick being $6 to the smallest tick being $1, or the smallest tick being six pennies.
$6.25, by the way.
Yeah, $6.25.
Yeah, it was a 16th, right? Yeah.
Yeah, to being a penny. So you went from $6.25 to $1. Yes, it was a much smaller tick.
So do you think that zero DTE trades or zero DTE options are having a similar effect today in terms of the barricades that they're taking down in the marketplace?
Well, I think the zero DT trades have opened up trading to a lot. They've attracted kind of more people and a new breed of trader.
Okay. And do you think that's good or bad?
Well, of course I think it's good. Anything that brings people into the business is good. Yeah, I think it's huge.
Yeah. Okay. So, I mean, and that's exactly the pointer. This has been, in my opinion, I mean, I don't have nearly the experience that you guys have, but thinking about the last just 20 years or 20, because decimalization happened, was it 2000 or was it late 90s?
I don't know. Tony might remember. I don't remember.
I think it was early 2000s.
And I actually tried to look it up, and I didn't get a good answer for the year. I believe it was around 2000 or 2001.
I think it was before. I don't remember us launching Thinkorswim with fractions. So I think we had decimalized prior to 2000. But again,
it was implemented for all options and equities April 9th, 2001. The phase-in period began in August of 2000.
Okay, that makes sense because that's right about when we launched, and I don't think we launched with fractions at all because fractions made it much more difficult to post prices. So we launched with decimalization, but the zero DTs didn't come on the scene until much later. We presented the concept for zero DTs to the CBOE, and I think it was in 2005 or 2006, but I don't remember exactly. But, I made the first presentation, TP and I worked on it, and then the CBO introduced it, we worked with their new product committee, and then they introduced it 6 months later in the SPX only, and only for certain, they started with weeklies and only for certain, certain series.
Yeah, the more trade, what they considered to be the higher traded one, right?
Yeah,
more active.
That's really interesting because when I think about zero DTEs, I think about these really only being kind of, for lack of a better word, relevant the last few years.
They started in 2022.
Yeah, right. And so, so 2005, 2006.
I mean, I think we presented it around 2000.
So you pitched it and it got shut down?
No, it never got shut down. I mean, they actually debated it for a while, and then they introduced it in the SPX because they liked the idea.
Okay. Well, yeah, but I think that the last few years is when it's really caught in fire. The last few years. Okay, so
I think it took 7 or 8 years for them to really catch on. Yeah. Okay, so zero DTEs. Okay, Beth, hit us on the next slide. So what we need to understand is when you are trading a zero DTE option, whether you're buying premium or selling premium, like you said on Friday with, at work by 11, excuse me, you did a couple of short premium trades, Iron Condor, short strangle, and it worked out. And obviously that's great. That's all well and good. I know that, even the Tasty research team has done some recent research on strangles and win percentages and, chances of big losses and things like that, which is amazing. But regardless of which side of the trade you might be on in terms of buying premium versus selling premium, you still have to understand where you're at in the world of convexity. And that's what I wanted to focus on here this morning. So if you think about gamma over time, right, which is something we talk about all the time, I mean, this is the thing that actually informed the whole idea of managing at 21 days to go. It was the gamma risk that naturally increases as you get closer and closer to expiration. And looking at the research and measuring the empirical results and all the findings over the years, we all just kind of realized hey, wait a minute, it doesn't make a lot of sense to hold close to expiration. So thus, 21 days to go, rolling closing was born. And that's kind of why we manage our trades in a 45 out of 21 on kind of a typical trade. But when you get into a zero DTE world where you're actually engaging with the market, you're engaging with the strategy, at essentially its maximum point of convexity, you have to understand now that there's going to be extreme gamma risk
in that position. Now, of course, it matters what type of strategy you choose. If you choose a defined risk strategy, that's naturally going to have, muted gamma exposure because it's defined risk. But still, just by the very fact that you're entering at the very end of the option's life is just naturally going to expose you to a lot more directional risk. And so it's very different from what we normally do. And the way I look at this, it really gives you a way to diversify your risk return profile in some very unique ways where you can customize exactly what you want to do. Where maybe most of what you do is in a 45 out of 21, but then you're kind of splashing around, right? Then you're kind of, you're out there on a Friday, you're at work by 11, you're seeing Tom Sosnoff, lose a little bit of money, you're thinking I could probably do better than that. So then you go in at a 0 DTE, and then it kind of gives you a different feel. What do you guys think as far as 0 DTE in terms of how it blends with the rest of your portfolio?
Honestly, our 0 DTE positions are really small, and we don't really look at them as part of the rest of the portfolio. Let me give you an example. If we do a 0 DTE trade, first of all, we're looking at it usually for like an hour. And so when we do a regular trade, like that's like a 45-day expiration trade, we look at that as part of our portfolio. When we do a 0 DTE trade, we don't think of it as part of our portfolio. We just think of it as a very short-term trade. That's one thing. The other thing is with 0 DTE, we're not necessarily as volatility conscious because we know we're not holding the trade overnight, so it doesn't have the same volatility concerns. And so I don't really think that we do look at 0 DTE trades in the context of portfolio trades at all. I mean, I'm not speaking for Tony. He can say whatever he wants, but that's what I think.
You're on. Yeah, you're on.
What do you think, Tony?
No, I think Saz has it right. I think that's exactly right. I mean, 0 days are almost like scalping. I guess I'd put it that way.
Yeah, fine. I agree.
That's actually exactly what I was thinking in my mind. It's kind of like you've got your short premium, like you've got your breadwinners, you've got your, the tried and true. And then if you're scalping and doing things like that, the 0 DTE is going to kind of fit into that bucket. Yeah, okay, excellent. All right, so Beth, hit us on the next slide, though. So here's the main thing, though, and this is what I want people to really take away, the gamma, gimmies, and gotchas. So again, one of the things I like to say on From Theory to Practice all the time is you have to know what you're signing up for. Like, you have to be very clear, what am I signing up for? Like, do I really understand the pathway that I'm about to go down through the forest? Do I understand the gimmies, the gotchas, the pitfalls, the obstacles, etc.? Well, that's kind of what we're going to talk about here this morning when it comes to 0 DTE options. If you buy a 0 DTE option, you're going to have positive gamma, even if you buy a spread. If you sell 0 DTE options, you could have negative gamma. Like, even if you sell the spread. Again, spreads, it's a lot more muted, but the spirit of what I'm saying is still obviously there. When you buy a 0 DTE option, or when you buy really any option, you obviously have limited losses, unlimited potential, right? So you have this asymmetric relationship between risk and return, and that's going to work in your favor. So the extreme convexity that you're picking up at the very end of an option's life is actually going to work in your favor because your losses are limited by nature. If you sell options, though, you're on the other side of all of this. So now all of a sudden, you're exposed to unlimited losses, like with your strangle that you did on Friday. Obviously, that's unlimited risk. Like, we know that very well. Whether it's in at 45 or in at 0, it doesn't matter. It's an unlimited risk trade, which is totally fine. Like, we do that all the time. There's nothing wrong with that. Inherently, it's an extremely effective strategy. But again, you just have to know what you're signing up for. In a 0 DTE world, not only do you have unlimited risk, but you're at the top, the maximum point of convexity. So if there is a move that goes against you, if you do happen to catch the wrong end of the stick, which happens to you often, Tom, you have to understand, kind of what could potentially go wrong on this strategy. And so the asymmetric risk and return is working against you with the short premium position. And so, when it comes to the negative gamma exposure at maximum convexity, that's not exactly the best combination that could ever be, kind of put together. And so just when I think about 0 D, this is not a you should do them or you shouldn't do them type of thing. This is just a, hey, this is what you're up against. Like, this is what you're voluntarily engaging with. the maximum point of convexity, in terms of the time left in the strategy, especially if you do something that's under unlimited risk, you have to understand what you are indeed signing up for. And I would say, and this kind of, I'll be curious to get, you guys' take on this, because if you start to think about putting zero DTE into the bucket of scalping, if you look at my green box there at the very bottom, I think in a zero DTE world, this is where actually doing some naked long premium could actually make some sense. And I mean just a long call or a long put. Now, if I was going to do it, I'd probably want to go pretty deep in the money. I'd probably want to try to minimize the extrinsic value exposure and have, a lot of delta. I don't want to probably do something that's out of the money. I would probably want to do something that maybe is 80 delta or higher. But still, I mean, from a capital efficiency standpoint, if you're taking a directional shot, I don't know. I think it can make some sense, especially if you want to take advantage of the convexity in the market.
Now, you're 100% correct, Dr. Jim. I mean, if you're just looking at it as a directional bias for a relatively inexpensive way to get 100 deltas for a very short period of time with very tight markets, there's probably no better product. If that's the small caveat that you're going to put towards it. Yeah, I agree with you. No real difference than futures, although now you can get much smaller futures, meaning, macro, smaller than E-minis. You can go to the micros. You can get a lot smaller. You get to 100 delta. Doing the same thing in SPX, it would be about the same. So yeah, you're right.
Yeah. Exactly. I think even the buying power, I think if you matched notional for notional, you'll actually get better buying power efficiency using the zero DT options deep in the money relative to the futures.
Sure.
And so that can just be another thing to think about. I don't think it may not be a huge difference, but again, if you're really trying to optimize your portfolio allocation, it's something to think about.
Yeah, and if you're doing it late in the day, it's a relatively smaller priced product. You don't even have to go deep in the money. You could almost go at the money with very little extrinsic value to it, depending on the time frame of the day. You could go out of the money and take that shot on those very small priced options that really only $2-3 out of the money, and they're trading for under $1, and we get moves that sometimes are larger than that in a small period of time. I get the allure. Throwing everything else out, probability of success, blah, blah, blah. I get the allure, and you're 100% correct.
Tom, do you have anything to add to that? I mean, it's tough to add till you're 100% correct, but you want to take a shot?
Well, we've done a fair amount of research on this topic, okay? And so I don't want to I don't want to bring facts into your subjective viewpoints here. But
my subjective viewpoint of convexity over time. Yes, please go on.
But in the end, we've actually researched this.
I think my waves are bothering you. I think you're seeing these waves and you're like, man, why don't I have those waves? How do I get some of those waves? I think it's got you a little rattled this morning.
I mean, they are a little disturbing. I'll give you that. Here's the thing, Jim. We've actually done a lot of research on this, and in the end, there is not a tremendous amount of difference between either one of these two sides as far as results go. But it does matter. There's a lot of nuances. I don't want to make it as simple as this, because there's a lot of nuances with zero DT trading, meaning we have found that if you participate in the early part of the day, like Tony and I generally prefer to do, you tend to end up, if you participate early, with more opportunity from the short side of options early in the day. Late in the day, the opportunity kind of swings to the long side. And so there are different points in the day when it's a little bit more optimal if you wanted to be long premium at all and play it directionally, where it's a little more optimal to take your long shot, with long options, as opposed to your short shot. I mean, I'm going to argue that if you're going to trade zero DTEs, directional or non-directional, and you're going to do it early in the morning, then you better be short. You better be short premium. It's very hard to make money being long premium early in the day. Late in the day, after the markets had maybe a little bit more of a chance to, pick a direction or set itself up a little bit, okay, fine. If you want to take a shot. The results in the end, based on our research, and Jacob and the team have done a literal ton of research on this, like hundreds of hours. In the end, the difference, very small either way.
Don't disrespect my man, Dr. Jim, by throwing out Jacob on here and making him look like he is not equal to or above Jacob in any way.
No. But there's a difference. Dr. Jim is more theoretical. Jacob is more data-based analytical. That's all. There's a difference between the two of them.
Okay, so I'm going to take the other side of that completely, 1,000,000%, but I'm not even going to go down that road because I don't even need to. I mean, the facts speak for themselves, right? I mean, you can go back and you can look, and you weren't even there. You were on Jacob's team, right? When me and the artist formerly known as Anton took you and Jacob down on mean reverting price. I mean, it was embarrassing, man. Like, it was embarrassing.
Yeah,
I had to hold back. I had to throttle it down towards the end of the segment. I'm like, this is bad. I'm like, I may not have a job. I may have the Willie Mays Hayes pink slip in my locker if I keep going. I got to slow this thing down.
I actually
formerly known.
I actually don't remember that. But I mean,
of course you don't.
I would block it out too.
No. I don't have. Man. Let me say, I don't have the same memory of that as you do. I remember you and your boy kind of whimpering into the corner and trying to figure out how you were going to regroup afterwards. No,
like you've seen Rocky IV, right? Like you've seen the beginning of Rocky IV when Apollo Creed is fighting the Russian.
Yeah,
and, I mean it's bad, man. Like from the start, it's so bad. His coach is in the corner, like let's end it, and Apollo was like, no, let's keep going, dude. That was you. You were like, let's keep going, and you just, I mean, you took yourself right down to your own death.
I know
it was bad, man.
No.
And people can look for themselves.
I feel pretty comfortable. I'm a good debater. I feel pretty comfortable.